Let's play out a thought experiment. What if tomorrow morning you woke up and mortgage rates were suddenly 0%, free money, no interest? Would that solve our housing affordability problem? On paper, it sounds amazing, but here's the reality. Even at 0%, many buyers would still struggle. Let me explain why. Right now, rates are sitting in the mid-sixes. That's already down from the peaks of last year, and it's helping a little. But Zillow says the typical monthly mortgage payment is still almost $1,000 higher than it was before the pandemic. Why? Because the real issue isn't rates, it's prices. Home prices shot up so fast in 2021 that even if the rate goes down, the payment is still heavy. Think of it like a car with a huge sticker price. Whether the dealer offers you 0% financing or not, you're still buying a really expensive car. That's what's happening with houses right now. The financing is only one part of the story. The bigger problem is the sticker shock. Here's the hidden piece of the puzzle: consumer debt. According to the New York Fed, credit card balances hit a record $1.34 trillion this year, with delinquency rates climbing to the highest level since 2012. When buyers are already maxed out on credit cards, auto loans, and student loans, a cheaper mortgage doesn't solve the problem. Even if rates magically drop to zero, a buyer still has to qualify under strict debt-to-income rules. And right now, more than 23% of mortgage applications are being denied, the highest rejection rate in years. That means fewer people even make it through the bank's front door. Now, the market has started to give buyers more breathing room. Inventory is up about 25% compared to last year, and homes are sitting on an average of 58 days on market. That's more choice and less competition. But nationally, the median list price is still about $439,000. That's not much relief when wages have only inched up a few percent each year. Buyers are saying, sure, I can find more homes to look at, but I still can't afford the monthly payment. Realtor.com reported that active listings jumped nearly 25% year over year, but the typical US wage only grew 4% in that same time frame. That mismatch is brutal. It's like opening the floodgates on housing supply, but the buyers at the other end of the pipeline don't have the income to actually absorb it. And remember, inventory is still 13% below pre-pandemic levels, so even the surge isn't enough to balance affordability. It creates a strange paradox: more homes on the market, but fewer buyers who can realistically step up and purchase. Now, here's the kicker: rents are rising right alongside home prices. According to Realtor.com, median asking rent is still more than 20% higher than before the pandemic, and in Phoenix, it's closer to 30%. That means would-be buyers are stuck in a trap. They can't save for a down payment because rent is eating their income, and they can't buy because monthly payments are still crushing. Even if mortgage rates drop to zero tomorrow, you'd still have millions of renters priced out by down payment requirements and closing costs. It's like a revolving door. They want to buy, but the system just spins them back into renting. Arizona shows us exactly how this plays out. Statewide, home values are down about 3%, and in Phoenix, they're down closer to 4.5%. The average Phoenix home is around $480,000 today. Days on market are stretching to about 70, and the Valley is sitting on more than 23,000 listings. That is a huge change from just a few years ago when you had to bid the same day. Now you can actually take your time. But even with low prices, the monthly payment is still tough for many buyers. Nationally, some markets are flashing red lights. Zillow data shows that values in Austin, Texas are down nearly 6% year over year, while markets like Tampa, Miami, and parts of Southern California are also posting steady declines. And it's not just home prices. Foreclosure filings in Texas metros like San Antonio are among the highest in the country right now, with 1 in every 2,300 homes in foreclosure. If these high-growth Sunbelt markets, which were supposed to be bulletproof during the boom, are rolling over, that suggests the correction is spreading wider and deeper than analysts expected. So let's go back to that 0% scenario. If rates drop to zero overnight, demand would explode. Everyone on the sidelines would rush in. Inventory would get snapped up and prices would start climbing again almost instantly. You'd get short-term excitement, but long-term affordability would not improve. It'd be like giving everyone a coupon at the same store. Prices just go back up because the demand surges. That's why real affordability doesn't come from gimmicks or sudden changes. It comes from three things: income rising faster than prices, rates staying lower over time, not just for a few weeks, and more supply hitting the market. That's the part we're starting to see. Builders in Arizona are cautious, but they're also offering some of the best incentives we've seen in years. Buy down on rates, credits for closing costs, and even backyard landscaping packages. I saw one in Queen Creek recently where they were throwing in $15,000 in upgrades. That's a sign the market is adjusting in buyers' favor. The National Association of Home Builders Confidence Index fell again last month, with builders pointing to what they call pricing ceiling. Translation, they know buyers simply can't absorb more, even with incentives. Housing starts are still up compared to last year, but permits dropped for the third month in a row, which is basically builders tapping the brakes. When the people who make their living selling homes are pulling back, that's not a good omen. They're reading the market in real time, and what they see is the buyer's pool is shrinking, not expanding. There's another storm cloud nobody is talking about: the adjustable rate loans written in 2020 and 2021. Thousands of those 5-year ARMs will be resetting in 2025 and 2026. That means homeowners who bought at 3% are about to see their loans jump into the 7 range or higher. For many, that's a $700 to $1,200 increase in their monthly payments overnight. Analysts at CoreLogic warn this could trigger a new wave of forced sales and foreclosures as homeowners realize they can't finance out of the problem. It hasn't hit the deadlines yet, but when those resets start hitting, it can be the next shock that turns today's correction into something much harsher. But here's a silver lining. Even though affordability is stretched, buyers have negotiating power again. Homes are sitting for 70 days in Phoenix, sellers are cutting prices, builders are offering deals. If you're patient, you can find opportunities that didn't exist in the bidding war years. Sellers, this means you can still win, but you need to price smart. Market your home well and be open to concessions. And here's the final piece of the puzzle: psychology. Realtor.com's latest consumer survey shows that only 27% of Americans believe now is a good time to buy a home, down from nearly 40% just 6 months ago. That's the lowest confidence level since the early days of the pandemic. And it matters because housing isn't just numbers, it's emotions. When buyers feel the market is against them, they stay on the sidelines. Economists now project that this sentiment drop could reduce sales volume by another 15 to 20% over the next year, even if prices remain flat. That's how corrections snowball. First affordability, then confidence, then activity. So no, 0% mortgage rates wouldn't magically save the housing market, but that doesn't mean the situation is hopeless. What it means is the market is normalizing, and for Arizona buyers and sellers, that's actually a good thing. It means fewer wild swings and more balance, a healthier market where both sides have a chance. So what did we learn here? Even at 0% mortgage rates, the housing market's problems wouldn't magically go away. Payments are still higher than before the pandemic, wages haven't caught up, and buyers are feeling the squeeze on every side, from property taxes to insurance to closing costs. That's why this isn't just about rates, it's about the entire ecosystem of affordability. For Arizona, this means buyers can finally slow down, shop around, and negotiate, but sellers have to be sharp. Pricing realistically and offering concessions can make all the difference right now. And for those of you sitting on the sidelines waiting for a magic interest rate drop to fix everything, well, the reality is the best opportunities may come during this correction while the market is leveling out. Now, I want to hear from you. If rates drop to 0 tomorrow, would it change your decision to buy or sell? Or do you still think affordability is the real hurdle? Drop your thoughts in the comments. I'd love to see what you think. And as always, thanks for watching. If you got value from this, hit that like button, subscribe, and stick around because I post new housing market insights and neighborhood tours twice a week. Remember, the market doesn't wait, but knowledge puts you ahead of it. This is Charles with HomeSmart.